In my mind, I'm gone to Carolina.
Greetings and welcome back to Fisher Wealth Management's Tips of the Week. I'm Rick Fisher again, and I'm the managing partner of Fisher Wealth Management. And this week's post is on volatility. The market has certainly given us plenty to talk about over the years, and I've had the opportunity to write several times of these market notes. The majority of these letters we've written or spoke about have been done during times of market stress. We had a post back in January of 2013 when the market was concerned about the impending fiscal cliff. We had another one later that year when the market had its quote-unquote taper tantrum over uncertainty regarding the Federal Reserve's actions. Back in 2014, we discussed the harsh winter's impact on the economy and the market sell-off due to the outbreak of Ebola and the rise of Islamic State militants. And last year, second half fears triggered by a decline in oil prices, weakness in manufacturing, and a slowdown in China prompted multiple of these posts. And although each of these posts is focused on a unique topic and addressed varying market challenges, they really all had one common denominator: fear. They all triggered a strong emotional reaction. Emotion is the most powerful fuel in humans. It drives us to love, to mourn, to cheer our favorite team, and to scream during horror films. Emotion is what makes life more than just a day-to-day routine. It makes it an adventure, full of rewards and sometimes disappointments. And while fear is not something we typically embrace, it is a necessary emotion. It helps us stay alert and seek security. And whether that means locking our doors at night or increasing our life insurance policy after starting a family. However, in investing, emotion is often counterproductive to what it takes to be successful. Emotion in investing is often your worst enemy. Keep in mind, in an average lifetime, say of about 80 years, we'll experience roughly 9,000 down stock market days. We will experience about 13 recessions on average, approximately 20 bear markets, and too many pullbacks and corrections to really even count. That's a lot of market declines, and each of them will be marked with fear, worry, and the instinctive urge to seek safety. But history has shown that investing with fear as the catalyst has never been a successful investment strategy. After all, very few of those 9,000 down market days in our life are actually a Lehman Brothers moment. Furthermore, fear causes us to sell at or near market bottoms and more often than not miss opportunities rather than add value with downside protection. Fear causes us to sell into weakness and miss opportunities far more than adding value to your performance or portfolio. We're currently going through one of these periods of fear. This is best evidenced by examining investor surveys, such as the American Association of Individual Investors, which this week reported that bulls came in only at 18%. So people that are bullish about the stock market came in at 18%. That's the lowest ranking in nearly 11 years. Think about that. The percentage of optimistic bullish investors is at the lowest level in over a decade. That means there's fewer people that are bullish investors right now than at any time during the Great Recession. Meanwhile, the percentage of bears spiked up to 45%. That's the highest level, people that are bearish, in about 3 years. In a nutshell, this degree of pessimism and the increased level of market volatility suggests to us that most of the potential stock market decline may very well be behind us. Lately, China and oil are most often cited as catalysts for the fear. And with the U.S. stocks firmly in correction camp, meaning come down by 10% or more, and many segments already in a bear market, meaning over 20, Japan, Europe, small company stocks, etc., We believe that selling pressure on stocks is moving to extreme levels, and at these extremes, the market tends to ignore all positive news and focus purely based on the worst case scenario. It's at times like this it's important to regroup, because we do not forecast that a worst case scenario is currently the highest probability event. In fact, we see the likelihood of a recession in the United States at roughly 20%. Now that's higher than a few months ago, but still really remote. Supporting our view is that corporate America outside of the challenged energy sector remains in very good shape. We believe it is in a good position to grow profits in 2016, despite the drags from the energy sector, a strong dollar, and slower growth in China. While we do not know for certain what lies ahead for any of us, this market, we believe the best course of action is to face it with a steadfast commitment to your investment plan. And instead of reacting to the urges of fear, maintain a patient long-term orientation to the future. That's always paid off the best. As always, if you have any questions regarding your specific financial picture, your specific portfolio, if it is positioned properly for this market we're in today, I encourage you to call our office at Fisher Wealth Management and speak to a certified financial planner that will be your advocate. Because remember, you are making plans for one retirement. We've made plans for thousands. Thanks again, and stay tuned for more Fisher Wealth Management Tips of the Week.